How we fought inflation in 1946. The recent surge of inflation has led the media and market pundits to look to economic history for relevant comparisons. America has suffered through bouts of inflation before, but many experts only consider the precedent from their lifetime, that is the inflation of the late 1970s and early 1980s that was conquered by the draconian interest rate policy measure of the Paul Volcker-led Federal Reserve. While that period's inflationary rise may invite comparison to today, its root causes funding the Vietnam War and the Great Society Social Policy Initiative of Lyndon B. Johnson de-linking the dollar from gold and an energy crisis were a different set of circumstances. A more appropriate corollary from history is 1946 to 1948, the post-Second World War inflationary episode resulting from supply shortages during peacetime refit of manufacturing plants, rebounding demands for consumer goods, high level of savings, and soaring money growth. This sounds a lot like today. As for how the 1940s inflation ended, supply and demand ultimately came back into balance, and the more primitive version of the Federal Reserve, which did not have this targeting of a benchmark Fed fund rate in its toolkit, slowed the economy by curbing money and credit growth and shrinking its balance sheet. Price increases slowed in 1948 and actually declined in 1949, and a brief mild recession ensued. Equity prices generally remained stable. This would be a welcome outcome today, but the execution of monetary policy over the coming month will determine whether inflation ends gently or with a serious recession and more market turbulence. The pent-up demand of post-war America was extraordinary. Between 1945 and 1949, a period when the U.S. population was approximately 140 million people, Americans purchased 20 million refrigerators, 21.4 million cars, and 5.5 million stoves. This was quite a rebound from the shortages of wartime America. At the same time, excess savings generated during the war and the increased post-war credit demands of borrowers in 1946 and 1947 by farms, homeowners, real estate investors, and industry further stoked the inflationary pressures. CPI inflation, which was 3.1% in June 1946, peaked 9 months later at 20.1% in March 1947. The spike in inflation followed a period of explosive growth in the monetary base and in securities held on the balance sheet of the Federal Reserve, which grew 300% to $24.5 billion in 1945 from $6.2 billion in 1942. This wartime rise was unlike what we have seen recently in the central bank balance sheet in response to the pandemic. How did the inflationary period end after the March 1947 peak? First, pent-up demand subsided and supply came on board as prices rose and manufacturing transitioned from wartime to peacetime activity. In other words, the market's invisible hand worked. Second, monetary policy tightened, but using a few different elements than what we see today. As explained in the 1948 Fed annual report, Federal Reserve policies during most of 1948 were directed towards exerting restraint on inflationary credit expansion, while at the same time maintaining stability in market for government securities, notably missing any talk of interest rate management. With the Fed likely to embark on a path of reducing its balance sheet while simultaneously raising rates, the risk is much greater that the result would not be a quick, mild recession like what we saw in 1949, but a much more serious downturn, greater market volatility, and a potential financial crisis. No one can control both the supply and price of any commodity, including credit. Given the record corporate debt level, the rich valuation of financial assets, and surging price for speculative investment, the prospect for policy errors are high. Policymakers would be wise to look to the past. Attempts to contain inflation in the 1970s will focus on targeting short-term rates instead of limiting credit creation by controlling the Fed balance sheet and the money supply. This policy was an obvious failure. After the financial crisis, policymakers seem to have lost faith in the power of markets to set prices and balance supply and demand, and have gained too much faith in their own ability to do the same. Perhaps a rational and disciplined approach adhering to monetary orthodoxy as demonstrated in the 1940s would greatly reduce the risk of policy error, avoid the inflation spiral of the 1970s, and reduce the risk of yet another financial panic.